Good evening, all. Uh, Today's topic is about basket strategy in terms of how the markets are being placed in the current environment. How could we invest in a smarter way in terms of looking at using baskets as a tool? So I would first throw you some light on why baskets are important at this point of time. Because see, individual stocks, there are multiple strategies in terms of investing. One is passive strategy, one is active strategy. So in terms of active strategy, what always represents is the direct equity part in picking up stocks. So many times, many players you get many investment ideas or many inputs you are getting across the thing. But ultimately, what you need to know is what is the timing of the entry of the individual ideas, and when to exit is very, very important in these markets, because markets have become more dynamic, more volatile, and more irrational, I could say. So this would continue for some time, because after the COVID wave, since 2024, market went into sideways, and markets have been under volatile scenarios. And if you ask me, last 1.5 years, there is hardly any return made in terms of if you invest directly and sit on a portfolios in terms of building a portfolio. But here, what we do in a JM is, what we have devised is, when we have met many thousands of clients and understand where the things are going wrong. In my 30 years of experience, and I went through meeting many clients and seeing their portfolios, what I could observe is, see, you get many stocks, people buy stocks and hold in the portfolios, but what the things happen is, and the core substance is missing, is people doesn't exit at right times, and people keep on accumulating the wrong ones. That's where you miss the alpha, and that's where you miss the core return generation. If you are investing through mutual funds or a PMS, that is a different strategy. But in active, I'm talking about active part, which is a direct equity. You must know when to exit, when to enter. These are the two important points one needs to know. So that is the ideal way of looking at is a basket. Instead of picking one stock, we are picking a basket of stocks. Why we are picking a basket of stocks is, there are around 5,000 odd strips are been there, and not all strips perform. If you look at the last 1 year, market has given you negligible return, but some stocks have given you multifold returns. In fact, in the last 6 months, if you look at Nifty 500 has given you, Nifty 200 has delivered a negative return of 5.7, whereas Nifty has delivered around 8.8% negative return, while some stocks have given multifold. So it is all about opportunity picking, how you want to be placed. So that's where the baskets will be useful. And why this is basket is useful is, somebody is tracking those baskets in terms of stocks. As a strategy, baskets can be built with a corpus of, if you have an ideal corpus, you can build a basket over a period of 2 to 3 years. That is the time horizon you should look at in terms of JM baskets, where we have a strong track record, because these baskets have been derived for the last 5.5 years. I've been running these baskets for the last 5.5 years, and we have a very low churn in these baskets. And there is a strong moat, and there is a strong discipline is been inbuilt in these stocks, where we track very closely in terms of how the baskets earnings scalability has been there, earnings visibility has been there, whether the right time to enter or a wrong time to move out. So all these things we kept in mind, and we built these baskets. So I will share you I will go straight away to my screen. So what I built is, I have built a framework in designing these baskets, keeping a description of how this product I want to run. I have built these baskets on 3 risk profiles. So the risk profiles I will explain you later. But what we are doing is, we are building a a good amount of focus stocks. There are around, we have constructed 3 baskets, nearly 45 stocks. Each basket consists around 15 stocks. So we have built a focus list, more focused list of 45 stocks. These stocks are being filtered on a core methodology of our framework, which we call it as a 4 pillars. So the first pillar is the size. Size means in terms of what is the market cap, where we are looking at. We are not looking into micro cap, or we are not looking into very, very large cap kind of a thing. But we are looking at opportunities from an opportunity point of view. We are looking at where this market size has been there and how the impact cost could be there, whether we can make a easy entry or we can make a easy exit. Exit is very, very important in this market. So there should not be any much higher impact cost should be there. So we are not focusing on the stocks below 3,000 crore or a 5,000 crore market cap. We are above that, and basically we are filtering the stocks from BSE 500, that is from BSE, mostly from BSE 200. So that's where we kept these baskets. The benchmark to beating the benchmark is a BSE 200. So the first filter what we go is size, which is the market cap. We carefully look at the market cap, how the stocks are being placed. Second, we look at the quality financials, so how the financials are being placed, whether there is a good amount of earning visibility is being there, or how the financials are being there so far, and whether there is a growth is there or not. That is the second part. The third part is the liquidity. How the liquidity, this is very, very important. As I said, the impact cost should not be much higher. That part we carefully take it over, because the liquidity is very, very important. The second part is earnings. Earnings, even if earnings are good, there should be a scalability. Whether the earnings are set to grow, whether they can scale it up or not, that point we keep it in mind. The third thing is, in this only what we do is whether even if it scales, it sustains on a quarter-on-quarter or a year-on-year, how the growth is being there, whether the pace of growth is consistent or not. That also we keep in mind in terms of picking up the stock. The third filter, which we call the third pillar, is even if everything goes right, you have a right market cap, you have a quality financials, liquidity is very high, earning scalability is high, sustainability is high, but pace of growth is there. But still, whether they are able to generate a strong return ratios or not, that is very, very important. Because if you see some of the blue chips, I would name where they have not done well, irrespective of, in spite of good financials, good liquidity, good market cap, good scalability is also there, they have not done well. Because sometimes what happens is the price could have discounted, the earnings could have discounted much faster earlier itself. So we look at how the stronger return ratios are being there in the thing, and there is a ample visionary management is being there, because we go by analyst con calls where we look at whether their management is able to sound, where their management is able to pitch how their growth path is there. That part also we closely track it. The third, ultimately what we look at is whether they have a successful track record in terms of management vision. This is the third pillar which we look at. The fourth pillar, of course, it is a fair valuation, because valuations is the main important, because that is the key engine for any picking up the stock. Where there should not be any mispricing in terms of if there is a stock is already been priced, we don't pick it up. And fourth is the margin of safety. If there is a good element of a run-up is already been there, and if in spite of all these three pillars, and if there is not a considerable margin of safety, then we don't get into those kind of stocks. This is the framework which we kept in all these baskets, and we have designed 3 baskets where we would like to bring it to the client perception is how the clients want to be. If the clients want to be more in terms of a aggressive in nature, we designed a basket called active. Why we designed the active is it is more in aggressive nature and more building towards a high beta and a mid large cap oriented. So that's where the active is been there. The component of high beta and a high mid large caps is more versus a large cap, because we generally what we say is large cap stocks are preserved. I mean to say they are not wealth creators. They are wealth preservators. So you don't generally make a good alpha in large cap, but they can act as a pillars of your basket. So the 30-35% of the stocks will be in the large caps kind of segment, and 60-65 would be in the high beta and mid cap kind of segments, where because we can generate the alpha. Why we say this is, generally we say mid cap are wealth creators, and if you go into high beta and small cap, they are the wealth multipliers. So you need to look at from where do you position. You want to be positioned in wealth, your capital preservators, or you want to build get into basket of where capital can be, wealth can be created. Where the third part is where wealth can be multiplied. So all in all, what I'm trying to say is the active basket is meant for people who want to be in aggressive nature. If you take a high beta kind of a stock, the risk will be equal, but the return would be more. That's where the active basket is being placed. The second basket is a moderate, where the blend of aggressive and moderate is being mixed here. Slightly, the large cap component will be higher, but at the same time, the mid large cap and the small cap would be, it is a equal blend. More or less, it is equal. And the third basket is passive. It is a completely defensive. It is a completely opposite to the active kind of a thing, where 60-65% is in the large cap and 30-45% is in the low mid cap and low beta kind of a stock. So these are the three profiles which we kept in mind after going through scrutiny, after meeting many clients, and after observing many portfolios. Because generally we get a portfolios from the clients to reshuffle. When we see the portfolio, generally we construct a portfolio. Usually a portfolio suggestion is you should build a portfolio between 15 to 25 stocks, not more than 4 to 5 sectors. But what we see is there is a 50, 60, 70, sometimes 120 stocks also, because there is no follow-up. And the third part is you always buy the stock, and if it falls, you keep it like that only. It becomes a junk, and it becomes a there is no alpha generated, or there is no value addition. Nobody tracks it. You miss it on some time, and sometimes what happens is it goes away. So this concept is being bought in, that there is an active monitoring is being there in all the three baskets, so that somebody is tracking and somebody is advising you at a right entry and a right exit. Because whenever we are coming out of the stock entry or anything, what we say is we give you the rationale also why you should get into the stock. We give you a very short note on the stock, why you should get into the stock, what is the key catalyst behind to enter into the stock, and what kind of a return can be expected from this stock. That also we give you. So our focus is on beating the benchmark, that is the Nifty benchmark, on a wider range of outperformance. And these baskets can be used as in terms of portfolio restructuring. We always advise them, you pick up your risk profile as per your risk profile, and pick up the basket, and so that you can fine tune your existing portfolio into these kind of a basket, so that there is a active monitoring is being there, and there is no cash. Interesting thing is there is no cash component, so we don't keep any cash at any point of time. In the last 5.5 years, there are many events have happened, and people have sold everything, and we have not sold anything. We have continuously monitoring the thing, and we deployed the cash all the times, and we don't use cash at all. And there is hardly at any very, very rare time, if in future we kept a provision that there could be a cash component of 3 to 5%, but in this 5.5 years, we never used any cash component. So even now, all my baskets are fully invested, and it has been completely occupied. And as of now, all the three baskets, we are running over 45 stocks. Each basket is consisting around 15 stocks. This is about this entire episode of baskets, and I will show you how the basket is being designed. So this is my active basket. where we have picked up around 4 to 5 sectors. And if you see the risk profile, it is a moderate to high. There is a riskometer is been there. There are 15 stocks have been there. And what is important is whenever we give you an update on entry, we give you update on exit also very equally. And here the timeline for each and every stock is 1 to 2 quarters. That is the maximum time horizon we keep. And so far in these baskets, we have delivered. We have initiated almost 472 ideas. Currently, 45 ideas are open, and the rest are being closed in this 5.5 years. And the strike rate is around 80%. Strike rate has been generated. And so far, if you look at, I will also show you how the returns have been there. See, before showing the returns, I will give you also about in one liner what is behind the stock, and we will give you even not only the one liner, we can give you full details about the stock also. Why? But in this presentation, I have made only one liner. What is the key rationale behind the stock that is being included. I'm also showing the moderate basket, where if you see the riskometer, it is low to moderate, because the combination of large cap and a combination of high beta is it is been mixed. It is the blending is almost equal, near to equal, and that's the reason you have seen a low to moderate kind of a thing. Riskometer is been there. And the third one is passive. Here, if you see, the riskometer is low. And here the combination of stocks is more in high beta, large cap, and the combination of low beta stocks are being included in this. So the return expectations also you have to keep in mind is in the passive basket you have toned down. You have to keep the return expectations also be on the lower side only, because the nature of the stocks picking up is in the passive mode. These are the returns which we have generated so far in the last 5.5 years. If the Nifty benchmark has delivered around 89%, whereas the aggressive portfolio has delivered around 112%, nearly 20 to 23% alpha is being generated in this in the 5.5 years. And if you see, look at a CAGR, it is around 14.73. Ideally, what we are looking at is any capital which we bring in this baskets, the capital should double within less than 3 years. That is the ideal approach which we kept in mind, and we are on the process of meeting that expectation. First, we have succeeded in terms of active. We are also working on moderate and passive also, where we would like to enhance the returns. And in these returns, we also calculated the total return index, which has been calculated. All the corporate actions are also been included in this, and even in the return expectations, we have also calculated in terms of whatever the costs have been included. So there is no any charges are being included in these baskets. These baskets are being placed on Equity Ninja. So anytime anybody can look into that. And the minimum size of investment, what we advise is minimum 5 lakhs can be invested. That suggestible amount is 5 lakhs, and it can be scaled up to any extent. And because the baskets are being placed with non-impactable, there is no impact cost at all in building the stocks. That's it from my end, and I'll open the floor for the question and answers. So, if I presume the client, it has to be gone by the risk profile, as I explained. If the client is want to look at an aggressive kind of a thing, and even in the current circumstances, given the market nature, I would strongly advise, because the markets are been in a time correction. Markets have been underperformed quite some time. I would look at active would be ideal strategy, because active has been doing well, phenomenally well in the last 5.5 years, and in the last 1 year, in fact, it has been turned very well. And if you look at all these baskets, till from 2021 to 2024, every basket has done phenomenally well. But 2024 to 25, there was a challenge because some of the stocks went in underperformance, mainly particularly IT has went into underperformance. At that point of time, we had to take a call where whether this we are able to succeeding in terms of generating alpha or not. So we also book losses also. We don't say that everything is being run on profits only. We also book losses also, because it is one must know that when to cut the losses. The otherwise you will not be able to generate the alpha. So we have exited IT stocks much earlier in the last 3.5 months before only. So that's where we play these baskets much ideal way of putting in a smarter way, so that in one click you get all the stocks, and there is a time to time there is a rebalancing is been there. So you get whenever we see there is a reasonable amount of alpha is being generated, we exit that stock and we pick new stock. So that's how it is being placed. I would suggest if somebody want to look at these baskets at this point of time, the active basket would be an ideal choice, unless until somebody like coming at 50 years and above, then I would ask them to go into moderate. See, currently markets are in markets have underperformed for over the last 1 year. But as I said, some of the stocks have done phenomenally well. If you look at the valuations are been not on a neither cheap, neither expensive. We are at a nearly around a 10-year average. We are currently at a 19.8 times to the 27 earnings, and if you are going with the 28 earnings, we are at around 18.8, 18.9. That is the estimate which we roughly have. Usually what we see is at the time of earnings, we generally say that 14 to 15% earnings growth will come in the forward year. Every time sometimes it happens, sometimes it doesn't happen. Last 2 years there is a not a good year to say that earnings have been robust. So last 2 years it was on a sideways. We have been seen some derating in terms of India, particularly. We don't have a kind of a thing, but we are more diversified. What I would say is, some of the global markets, if you see, they have been running, no doubt, but they have been on a purely on a one story called. Very few stocks have been lifting the thing. It is not a broad-based rally, or it is not a diversified markets in the global. But if you look at India's story, India is more diversified. Yes, I agree that the macro story had to be reshaped. What I say is there is a measured optimism is getting in, and it is slowly building in. So what I see is the macro story is still intact. Of course, there are several challenges are being there. We have a big challenge on the oil. On that front, we have to see how the government would act. So far, the government has succeeded in terms of meeting the challenges. So what I say is the markets are fairly at around the valuations, and I see another 6 months it would be on a building stage only. I don't see big upside coming in terms of index. So all in all, what I could say is the floor could be somewhere around 18 times to 20 times. That's where the 21 times could be the thing where we would see we move in this band in the next 6 months. But in the next financial year, we see there is a greater optimism should come back. Because what I say is there are a couple of market is looking at to discount. One is on the Fed policy, because we have a new Fed chair, Kevin Warsh, how we want to shape up, how the global markets could shape in, and ongoing geopolitical tussle, how it could move further. So all in all, market has discounted some of these factors quite fast, and in fact market will be moving very in a narrow band, and it is in the consolidation, and it would remain for another 6 months. It would be in a narrow band and in a consolidation band. But opportunities in the broader markets. So stock picking is the most important thing, and if you are in the right stock and the right sector, definitely you would make money. See, because it is a narrow consolidated market, you should know because time to time sectors will rotate. See, in the last 6 months, if you ask me, there is a good amount of power equipment, power utility, power stocks are phenomenally well. And if you look at IT has not done well in the last 1 year. People who were in the last 2 years in IT, they have not made any money. And people who are in a power and power equipment kind of a thing, and even a defense, people who are in there, they made good amount of money. So you need to choose the sectors where relative strength is been there, where in terms of earnings visibility is been there, where not only earning visibility, it adds to whether the price action also matters, whether the price action is suitable for you towards the sector, whether the sector is able to garner the limelight in terms of policy announcements are been coming from the regulatory side or from the government side. So all in all, what I say is, and then the entry and exit has to be tuned to the sectors which can generate alpha, and underperformance has to be cut timely. Because if 1 month is okay, 1 quarter is okay, but 2 quarter underperformance in this kind of a market is certainly needs a valid recheck. Because sometimes what happens is years to year you don't see any outperformance. Look at some of the stocks, blue chips. You name any blue chip in a private banking, some of the stocks have not done very well. So ideally, what should you see is picking up the sectors at the right time, and more importantly, you should also book profits at a timely is also a matter. So if corporate earnings are going around 13 to 14%, and you are looking at a return in the absolute return which you are making within a 1 to 2 quarters, that's the ideal way of churning out and moving into other. If you're a long-term investor, that's a different thing. If you have a time frame of 3 to 4 years, that is a different thing. Here the baskets are being placed, and these stocks are being placed to 1 to 2 quarters. This is a medium-term opportunity strategy where we pick up the stocks and build the baskets in this medium-term opportunities place. No, we don't. JM Baskets, we don't charge any fee. It's a free. We don't charge anything. See, ideally, what happens is mutual fund. You pick up some 50 stocks or 60, 70 stocks would be there. But here it is a more focused. See, each basket consists only 15 stocks. So we are our approach is more focused, and in future we have a plan to scale it up to 2025. But in the next 1 year, I don't see this. The current strategy only will continue because the workings are going on. Still, we need to look at the results, how they have been placed. But currently, in the next 1 year, we will be continuing with the 15 stock strategy only. Thank you all.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.